We're live. Let's go.
Let's go. Hello, everyone. Welcome to our webinar tonight. It says the 24th of October, which is not correct. It's the 23rd of October, I believe, if I'm in the right time zone. I appear to be. Yeah, so tonight we're just going to have a bit of a yarn about interest rate updates and a few other things that are going on in the market. So I suppose this is probably helpful for anyone that's first home buyer, looking to buy property just in general, and anyone coming up for refix or looking to restructure their borrowing. So it's a bit of a covers everyone type of webinar. So tips and tricks for success. Yeah, there's a few things along the way that might help. So I'm Adam. I'm a mortgage broker, mortgage advisor with My Mortgage. Amber joining along with me, another one of our advisors. And yeah, we'll just take some turns in chatting through some slides, and hopefully you get something out of it. We're recording, so if you want a copy of it, then yeah, we can forward that through. Just drop a thing in the chat, and yeah, we can fire it through. I don't think it's like automatic, is it? Probably not.
No, I don't think
Sweet.
so.
Are you in control of the slides?
Yes. Do you want to do this one? Do you want me to do this one?
Thanks. Yeah, I'll kick off. I'll kick off. Cool. So yeah, OCR is big news, right? We hear a lot about the OCR. Obviously, we follow what's happening with the OCR. We have a lot of clients that ask us about the OCR and how that impacts fixed rates. And I suppose the truth is we don't have any more information than what you guys have. It's all very, we keep an eye on it, but we don't have any insider information. We keep an eye on what's happening. And I suppose the OCR is only really one thing that is a factor in overall fixed fixed interest rates. Um, but in saying that, like as the OCR goes down, the typical trend is that fixed rates tend to follow. So yeah, you would have seen possibly that the OCR had a reduction at the last review, so down another zero point 0.5 to 2.5. So the current cash rate being 2.5. We're expecting that to probably drop again at the next review in November. Um, and we've already seen sort of fixed interest rates come back just in response to that, along with floating interest rates, which tend to move a little bit quicker. But yeah, it's had an impact on fixed interest rates, and rates are looking pretty good when you compare them across, where they tend to sit um, in history, global context. I guess this is pretty similar across the globe. Like everyone's kind of recovering from COVID and a downturn in terms of economy. And the trajectory seems to be that interest rates will continue to probably drop, but we're not talking 1% or 2%. We're talking, maybe another couple points, basis points, in the next sort of 3 to 6 months. And then hopefully we should see some plateauing. And when I say hopefully, I just mean that like it's a bit nicer in an environment to be purchasing property when interest rates aren't like booming or busting. Um, so yeah, I think at the moment, well, we'll cover off interest rates, but I think they'll probably sit around where they are for the next sort of 12 months. Beyond that is really hard to say. So we'll cover off some of those things. Um, we'll chat through changes in the 1 to 5 year rates, and yeah, like I mentioned, next reviews in November.
Oh, I'll jump into here. So
So I'll cover
this
this, and then you
is
can do the next two slides, eh?
yeah,
Oh yeah,
yeah.
you jump in.
Yeah, so we've got interest rates now. This is a pretty good indication of where most of the major banks' interest rates are sitting. Some of these are updated as of this afternoon. We have seen a little bit of movement in terms of the OCR timing and how interest rates have moved. The OCR is a wholesale interest rate that the banks borrow money at. So they add their margin onto that. And so, yes, there's a correlation in terms of how the OCR moves and how interest rates move. But some of the drops that we see in the OCR won't necessarily carry through into the rate drops that we see with the banks. Um, so right now, the cheapest interest rates that we've got there are 18 months and 2 years. But there is very little difference in most of these main fixed rate offerings. So between 6 months to 5 years, 0.2% is the variance in all of those for most of the banks. In terms of 6 months, the 6 month rate is obviously higher than some of those other offerings, so it's going to cost you a little bit more in the shorter term. The drops that we're expecting to see or likely to see in the coming months aren't likely to be that significant. So fixing for 6 months is probably best suited to people that are wanting to secure a cheaper rate in 6 months' time, and a cheaper rate is more important than having any kind of certainty. So heaps of flexibility is important. Or if you're planning changes to either your lending, selling, paying a significant amount off, or just wanting to review your repayments at that stage. 12 months to 2 years, obviously those rates are now sitting very, very similar together. 12 months will go by really, really quickly, as we know. It's still a short-term rate. It offers you a bit more certainty than 6 months while taking advantage of the best rate that we've got on offer, but not looking too far into the future, so you can still make those changes. 18 months, 2 years, you're kind of getting more towards that short to medium term. Will work better for people that want a little bit more certainty in what their repayments are going to look like a little bit longer. First home buyers that are getting used to having a mortgage, sometimes this is a really good fit. And obviously all of this is based on your scenario, but some of where these rates might fall. The 3 year rate now, I think, is offering some really good value. A few years ago, the 3 year rate was kind of a sweet spot. When we had those really low rates, the 3 year rate, once those kind of came around, that's when we were sort of starting to see rates plateau and come back down again. It is likely that you will pay slightly more in interest or more than the market in the first portion of that fixed term, obviously being higher than where those shorter term rates sit. But as that term progresses, if rates do plateau and increase at some point, that's where that value is going to sit. In sort of that 3 year rate. And similar with the 4 and 5 year rates, this requires a huge amount of certainty. If there is any chance that you might want to do something else, the 4 and 5 year rates may not be for you. They do, require that certainty, but give you that longer term stability and certainty in repayments and what that rate looks like. So generally those 4 and 5 year rates on investment properties can be a really good fit. Particularly if the interest is deductible, you kind of set and forget, you know exactly what it's doing, and don't have to worry too much about it. The floating rate revolving credit offset product, these rates here are quite variable depending on the bank. So some banks' floating rates are a lot lower than other banks' floating rates. For the most part, floating will work if you are wanting to pay off your lending as fast as possible, if you've got additional income coming in, seasonal type income, fluctuating income that helps you to pay things off a bit quicker. Or revolving credit or offset products work really well if you've got additional cash or savings on hand and you want to reduce the interest on your lending. So a lot of the time, the revolving and offset products, you're not going to pay the actual interest rate that you've got there, because you're going to be offsetting a good chunk of that. But yeah, in terms of where those are, these have come back quite considerably over the last 18 months or so now that rates have been coming down. Even this year, we've seen these drop quite significantly, which is really, really positive and really exciting, especially if your lending is coming up for refix or you're in the position of looking to purchase. So yeah, that's a bit of an oversight of where rates are at. All banks vary slightly. These are also based on having a 20% deposit or 20% equity in your property. If you have under 20% deposit, the rates will vary slightly, or they can vary slightly, depending on the bank and maybe a margin. Yeah.
Maybe just while you're on that, I don't mean
Hmm. Jump in.
to derail, but like, are you doing much in terms of splitting borrowing? So if someone's got 600
Yeah.
grand
Yeah. Good
as a
question.
total loan, are you doing much split loans?
Yeah, absolutely. I think that there's now offer a really good opportunity to when your lending is coming up for review, just to split this into a couple of portions, or if you're taking out new lending. So if you've got it doesn't actually matter how much lending you've got. You could have a small amount or you could have a larger chunk of lending. It works a lot better when you've got a larger chunk of lending. So splitting your lending can split your risk. Right now, with rates coming down, the changes in your interest rate and the changes in your repayments are less impactful than when rates rise. So splitting your lending into a couple of buckets mean that when rates rise, because at some point they will, all of your repayments and your rates aren't going to come up at the same time. So it can be really, really beneficial longer term. In terms of the split and what I'm recommending to a lot of clients at the moment is there's some really good value in the shorter term rates. As Adam mentioned, we are expecting rates to come back a little bit more. So with that, those shorter term rates offer some good value to take and flexibility to take advantage of the best rates as they come up. So you're looking probably 6 or 12 months. At this stage, using our little bit of a crystal ball, it's likely rates will be similar, if not slightly cheaper in 12 months. It's probably more likely that that's the case than them being more expensive. There is obviously a chance that things may change prior to that. But if rates continue to stay as we expect, the 12-month rate can offer you really good flexibility to review your lending. But then also having a bit of balance that, hey, if rates actually don't come back any further, and you're like, if they do start going up, I want to have some certainty. I want to know what repayments look like. Balancing that out with something a little bit more longer term can help with reducing that risk and splitting that risk over time. So, depending on how much lending you've got, depending on your appetite for risk, and also your plans, splitting your lending onto a couple of portions and taking advantage of the different rates that are on offer can be a really good fit. And as you mentioned, because the rates are so close together, the difference in repayments can be quite minimal. So having some money in different buckets can be really useful. Yeah. Anything to add, Adam, on that one?
Cheers. Um,
Regardless.
no, not really. I think you covered it all. Do you want me to jump on this one?
Yeah.
Yeah, cool. All right. So how to decide which rate is best? There is no best rate. It's a bit like best bank. We get asked which is the best bank quite often and totally dependent on your situation, right? So Amber's covered quite a lot there, I think. Probably covered some of these things. So changes in your situation like are going to dictate what you're going to do in terms of which rate is best. So there is no rate, no best rate as such. You might be expecting, I don't know, a child in the next 12 to 24 months. That might dictate what you do, and that would kind of like alter the type of advice that we give around which is the best fixed rate. Um, the other thing is it totally depends on your money personality as well. Something that I say to people all the time is if I fixed you for 2 years today at 449 and in 3 months' time you saw a better rate than that, would that piss you off? And if the answer is yes, well, then you're probably slightly better suited to a shorter term fix if you're expecting rates to go down. Um, so yeah, it totally depends on your situation. It's very hard to tell you which rate is best without knowing your exact situation and what type of money personality you have. For anyone that needs certainty at the moment, I'm fixing a little bit longer. For anyone that wants flexibility um, and wants to possibly chase a better rate and has the risk tolerance to um, absorb a higher rate just in case rates did go up, then we'd be looking at a shorter term fix. So yeah, should you float? So this is kind of like you get to the end of your fixed term and you're hearing all this stuff about the OCR possibly going down and that fixed rates are going to go down. Should you float? We get that quite often, or possibly that you're buying a house, it's a new loan, and you're going, oh, I don't want to fix yet because I've heard that rates are going to come down. Again, it's kind of like dependent on your situation. We have some good cases where floating for the next few months may be a good option. But for most people, I think you kind of need to, personally, anyway, I say to most people, you need to think about what, the decision that you're making today rather than what's happening in 3 months' time. You could float at that higher rate. And depending on which bank you're with, like you could actually pay quite a lot more interest over that period than just fixing at today's current rate and trying to chase a unguaranteed or unpromised lower rate in future. So yeah, I think should you float is definitely like a talk to your advisor type situation because it could work, but a lot of the time probably doesn't. A lot of stuff that we're doing at the moment is looking at different loan products. For example, lots of banks offer offset facilities, so ways that you can save interest by offsetting your home loan with savings you might have, and refinancing options, so moving from one bank to another. And there's a good case for moving from one bank to another in certain situations. In other situations, it may not make any sense. And so you kind of need to run those numbers with your advisor and just make sure that it does make sense. An example would be if you were coming off your fixed rate and you had a portion of borrowing that you wanted to move to a new bank, that new bank would pay cash back for you to do that if you were outside of any type of clawback from your current bank. And that situation might work quite well. That new bank might offer a product that your current bank doesn't, like an offset facility, for example, that you want to utilize. There's lots of good reasons to refinance, but there's also some reasons just to stick with your current bank. And so I think like checking with your advisor and making sure that refinancing is the right thing to do, is a good conversation to have. Next 1 to 3 years on how to decide which rate is best. Again, I kind of covered that at the beginning, but think about what's happening in the next 1 to 3 years. If you're thinking, hey, we might sell in 12 months, we're not going to fix for 3 years because we're just going to expose you to break fees. You might, if you've got other plans, if you're thinking about buying other property, if you're thinking about refinancing, if you're thinking you might have an increase, like a major increase or a major decrease in income, then longer term fixes don't always suit. So yeah, it's just planning around those like big life events and big changes and making sure that you've got the right fix rate. Yeah.
Oh.
Is my internet holding up in the country?
Yeah, it appears to. I think there might be a delay
Yeah.
sometimes, but
Cool.
it seems to be working.
Okay. Do you want me
Cool.
to cover this?
Yep, go.
Okay, cool. So taking advantage of cheaper rates. So obviously lots of people at the moment coming off 6 point somethings and going on to 4 point somethings, which is really nice, right? You're kind of a bit like with bread and milk and butter and coffee and beer and everything else going up in cost. You're a bit like, oh, it's quite tempting to go onto a lower rate and just set my repayments to minimum. I'm guilty of that. But we're having lots of conversations at the moment with people who are coming off their higher rate and going on to a lower rate. So as the first point mentions, we've got about 200 billion of lending. Is that right? Due to refix in the next 6 months.
I believe it's like
So I guess what that means is
60% of
that,
all lending.
yeah, okay, all right. So we've got heaps of borrowing basically out in the ether that's going to come off a higher rate and go onto a lower rate. And so like, what does that mean? And I guess it just means that like there's going to be more money out there. People will have the ability to decrease their repayments if they want. But I think what a lot of people are doing at the moment and what having these higher interest rates have done has kind of like done a bit of a reset in terms of people's budgets. They can sustain repayments at that level and they're kind of going, actually, we'd like to sustain that repayment and knock off our home loan a bit quicker than the standard 30-year term. Um, that might not be your situation. You might be like, I just need the reprieve. I just need to be able to buy more milk and butter and whatever it is. And so it's quite nice to have that option to drop down onto a lower rate, lower repayment with the lower interest rate. But what we are seeing is like people sort of going somewhere in between. So you might be paying $1,500 a fortnight at the moment. That might be dropping down to $1,000 a fortnight. And so they're going, let's do it at 1,200. So we're kind of going somewhere in the middle. Every bank is different in terms of how you can set that repayment. So again, chatting to your advisor as you come up to refix to see what what your options are is a good idea. What does that look like for you? Well, it's either more money in the back pocket or it's paying off your home loan faster. There's not many people coming off like COVID interest rates of 2 point something anymore. There might be still a few just lingering, but most people are coming off higher fixed rates and going on to lower. And then if you are going to make minimum repayments, where are you going to put that money? And we can have that discussion with you because there's lots of different ways of making use of that extra money so that it's not just going down the dummy. You could you could direct it into an offset facility. You could repay a loan that's at a higher interest rate. You might have an MTF or a UDC or a Gem Visa or something. You might channel that into those types of debts to get rid of those. There's lots of different things that you can do to make use of that extra money that's not just going to sort of like just be eaten up in day-to-day living. You might just want to go on holiday. That's fine. Break fees, yeah. So break fees at the moment are pretty bad. Depending on where you're at. Like if you're fixed for a long term at a higher rate, so if you're fixed through till 2028 at a 6 point something, break fees are quite horrific. They can be basically they can just sort of stop you from moving ahead with what you're trying to achieve. Like if you're trying to get onto a lower rate, yes, they can be prohibitively high, and it's just about working through that with your advisor and just seeing what break fees are. If you're thinking about moving your banking to another bank, refinancing, getting onto a lower rate, what does that mean in terms of break fees? We can run those numbers and make sure that it makes sense that you're going from a higher rate and onto a lower rate. And in some cases, that does make sense. You pay the break fee, you move on to the lower rate, you get some cash back from the new bank. It works out. In other cases, it may not, and so we just need to like work through that situation and figure out what's going to be best for you.
Okay. Great. So yeah, this is a little bit of an example. So just in terms of what your repayments might look like or how much they might be reducing by. So from a very high level, if you had $600,000 in lending and you were coming off a 5.99% rate going on to a 4.49% rate, if you were paying weekly, you could be saving about $173, or that equates to about $9,000 a year. As Adam's just kind of gone into, it's really up to you what works for you. If you have had a decrease in income and you're like, actually, we really need that money to feed our family, or like to buy things or do required maintenance or things like that, you may just want that money in your pocket to give you a little bit more freedom or a bit more comfort. You may decide to keep your repayments at the same level to smash your lending off faster. You might go, actually, we really want to do some renovations on the property, but we haven't had the extra cash. We haven't been building up our savings quick enough. So you want to funnel it into adding value to the property. So those savings, obviously, that's quite a significant amount of saving here. There are people coming off rates with a 6 in front of them. There are plenty of 6.99, 6.89% rates out there. So coming onto something with a 4 in front of it is pretty significant. So having a conversation around what works, what is best for you, is really important. Something Adam didn't mention, and what you also can do is by keeping your repayments at a similar level, it does build in a level of of a buffer in terms of when rates do rise again in the future. If you've kept your repayments at a higher level and your loan term remains the same, you're actually paying higher than the minimum. So when those rates do increase and your minimum repayments increase again, it's not as significant of a jump. So that can be something to keep in mind, is that rates will go up and down through the term of your lending. And so kind of when rates are coming down, taking advantage of that if you're in a position to can set you up really well for when rates do start to rise again. And just, yeah, putting another safeguard or protection in place for you. But yeah, that's just shows how much money can be saved out there. Again, you can split that. If you had 600,000 coming up, you might want to fix some of that for a shorter term and some for longer term. So yeah, very much personalized to what you want to do. Cool. I'll just roll through this quickly. So, in terms of what we're seeing in the market, so the feedback we're hearing from sort of agents and what we're seeing in terms of the clients that are coming to us and who wants to buy and who wants to do what, we are seeing a lot of first home buyers out there still. Probably a good chunk of what we're doing, our first home buyers going, sweet, the market is really great. House prices have come down or are sitting pretty comfortably for most parts of the country. And interest rates are cheap compared to where they have been the last couple of years, so it makes lending a bit more affordable. So yeah, we are seeing a lot of demand, a lot of people wanting to get into the market. The feedback we're kind of seeing is that there are more people going out there looking at open homes, looking at properties. There are still a lot of houses on the market, but not necessarily the volume of sales going through as yet. We will probably see, and we are seeing, more multi-offer scenarios. So when there is more demand and there are more people after those same properties, we're going to see more multi-offers where sale and purchase agreements where offers on properties are going to probably need to get a bit more competitive. Or people might want to be more competitive with those in terms of conditions or price. And that may also mean an increase in auctions at some point when we see more demand, more people out there looking. That tends to flow through. In the summer months, we also generally do see more properties come onto the market. A lot of people like to get things done by this deadline of Christmas or want to get it done in the summer. So we are seeing a few more properties come onto the market in line with kind of the demand and people wanting to get out there and purchase. It'll be really interesting to see how that kind of comes through. Obviously, there's plenty of people battling a little bit with the cost of living. And even though interest rates are coming down, the figures in terms of the overall economy right now still aren't great in New Zealand. And that's a huge part of what the OCR and the Reserve Bank are doing by reducing interest rates, is trying to stimulate that and create a little bit of growth. So yeah, we are seeing demand. We are seeing lots of positive things happening. It is likely and hopeful. We are hopeful that the market will probably start to get a bit stronger next year with interest rates being down, with the demand being there. Those are the signs of the market starting to pick up a little bit. It is unlikely, like interest rates, that things are going to go anywhere very quickly. But it is at this stage looking really, really positive into next year. Adam, go for it.
Sweet. Yeah, I think just like on the market overview stuff, I think it'll be good for buyers and sellers, like as we get closer to that equilibrium, because at the moment you kind of still got this sort of like weird scenario where it feels like it should be a buyer's market, but then you've still got a little bit of like competition. Maybe as we get closer to like that equilibrium, it will feel a little bit nicer for everyone, for vendors and for buyers. So yeah, servicing still improving. So yeah, over the last few months, we've seen like some decent improvements in terms of servicing. So your ability to borrow money, like affordability, is getting better. So I guess just to simplify it, like 2 years ago, someone that may have been able to borrow 500,000 could possibly be able to borrow 650,000 now. I'm just making up numbers, but I guess what we're seeing is test rates are coming down. So as interest rates come down, so as they sit at 4.49, the bank is testing you at say 6.5 or 6.9, and saying, hey, could you sustain repayments at this level? And so as fixed interest rates come down, so do test rates typically. And so that's just meaning that, yeah, servicing is better. So if you have been through the process, like in the last sort of 18 months, and you haven't landed where you wanted to in terms of how much you could borrow, then maybe now is a good time to really, go through that process again, and just seeing what you could do. DTIs are becoming relevant. Says about to, but I have had some pushback in the last couple of weeks around DTI. So DTI stands for debt to income ratio, and what it says is it's basically a new rule that the government's introduced, and it basically says that you can borrow as an owner occupier, as someone buying your own home, 6 times your income. So if you I don't know, if you have 100,000 between you in terms of income, you could borrow 600,000, max. I mean, there's a few little quirks in there. You might have border income or some other forms of income, but it's effectively your gross income times 6. If you're an investor, that goes up to 7, so 7 times your income, and that is becoming relevant. So it wasn't so relevant when interest rates were a bit higher, because what we'd find is that people would tap out their servicing, so their affordability, before DTI kicked in. But now, as interest rates have come down, DTI is starting to bite. Um, it's not really limiting people, I don't think, in terms of what they're trying to achieve. It's not really stopping people from doing what they want to do. You can still absolutely buy, you know, what you need with the income that you have, and it's not really stopping anyone. So I wouldn't let that get in the way of your plans. First investment properties, we're doing quite a few of those types of things. So people who may have purchased, I don't know, 4 or 5 years ago, have built some equity in their owner occupied property. So I mean, they may have bought their first home 4 or 5 years ago, have built some equity in that property. Now they're looking at buying their first investment property. That's becoming more possible, just with the growth in equity, and it's becoming more achievable in terms of cash flow because interest rates are coming down. Kind of what you saw for a little while is where interest rates were sitting at 6.5. It was hard for people to make sense of the numbers because you buy a house, and you'd be having to pump heaps of money into it every week to top up the mortgage repayment. But now it's kind of getting closer to being, you know, worthwhile, I suppose. It just depends on what you're buying, where you're buying, what the cash flow is like. And if you're doing that type of exercise, it's good to chat to us. We can give you some options in terms of lending, but then we can also put you onto people who can give you some advice around tax and rates and all of those different types of things. Make sure that it's that the cash flow is positive, or that it's at least achieving your goal. First home buyers, Amber, I think, covered that. That's personally my bread and butter at the moment. Lots of first home buyers, which is good because it's lots of good feels, I suppose, helping people get into their first home. There's lots of options for people buying their first home. So anyone that says that you need a 20% deposit is talking rubbish. There's lots of good options for people who don't have a 20% deposit, doing lots of stuff for people with 5% deposits, 10% deposits, and anywhere between that 5 and 20, doing lots of that stuff. So totally possible to get in with less than 20.
Yeah, and that is, I'll come back to this one actually. Let's roll through. Does anyone have any questions or anything they wanted us to touch on? Feel free to put it into the question. There's a question box comment section. Yeah, otherwise I'll just leave this here. We have a couple of other events coming up. We are trialing a community event, a wellness community event. So we've got a sweet session next Thursday in Cambridge. If you want more information, check out our website there or get in touch with us. We also have a Women in Property event coming up on the 20th of November. More of a networking, mingle, celebrate the year, talk about property event. And that one will be in Hamilton. If you want to chat with us or any of our other advisors, these are our details. Check out our website. There is links to book calls with all of us directly if you want to. Or yeah, reach out with questions, comments. When your rates are coming up, we are here to chat. We love to talk about the stuff, obviously. And yeah, I'll just go back. Have we got, I don't know if I've seen anything. Is there any questions there, Adam?
I think so. But yeah, send them through by email if you've got any, and we can come back to you.
Yeah, I think we've probably covered a huge amount of, yeah, quite a bit of detail. There's obviously lots of information. There's lots out there. Things are changing quite quickly at the moment. Obviously, we had an OCR, the last OCR announcement was the 8th of October. We saw a lot of rate movement in the week or 2 weeks leading up to that. Since then, we haven't seen anything significant, but we have been seeing small little drops almost every few days by a different bank. So there's lots of competition amongst the banks at the moment to kind of keep competitive in rates. And so, yeah, touching base with your advisor as your rates are coming up to make sure that what you're getting offered is the best that's out there. The rates that you see in your online banking and the rates that we get will be the same, but we can make sure that those are in line with the best that all of the banks are offering. And that's a huge part of what we do is staying across what every bank is doing. Yeah, as I said, we've had some movement in rates even today. The rates that are shown on banks' websites tend to be a little bit inaccurate. They can be a bit high. So yeah, always making sure because we're here to make sure that you guys are getting the best deal because we want the money in your pocket and not the banks. Yeah.
Thanks. You nailed it.
But that's probably it from us. If anyone does have anything that they want us to run through, let us know. Otherwise, yeah, reach out to us. We are here to help. Whole shame.